Hello, everyone. Welcome back to our Wednesday workshop at 1 with NuView Trust Company. My name is Brian Martinez. Thank you guys again for joining us. This is a huge turnout. We had over 180 people register for this workshop. We are so excited to continue our Magic of Multifamily series. Last week, we did a little recap of our first two guest speakers. I hope you saw that. If not, you can follow us on our social media. We post all of our recordings there. A great place to rewatch things if you missed anything. Before we do get started, just a disclaimer, who NuView Trust is. Well, we are a self-directed IRA custodian. So we do not provide any legal or tax advice. It's up to you to go seek that advice from an attorney or a CPA or whoever your financial advisor is. But what we do for you is custody alternative assets. So if you would like to purchase things like real estate, do private lending or mortgage notes or tax liens, invest in private equities, you can do that through NuView Trust as your custodian in an IRA or a solo 401k, health savings account, education savings account, any of those types of can custody these types of alternative assets. If you have any questions throughout the presentation, feel free to go ahead and submit those. You can do it through the landing page or social media channels. These are the directions posted right here for you. So if you have any troubles with that, go ahead and chat us. We'll do our best to guide you through how to submit those questions. And remember, we're doing a panel at the end of the series, so we'll bring all of our guest speakers back so you can go ahead and ask questions that you might not have been able to ask, or maybe you weren't able to attend live and you saw it on social media. Join us for the panel live, and then you can ask those questions to the guest speakers. Last thing is, if you scan that QR code, that's another way to go ahead and submit your questions as well. Looking forward to that. I'm really excited. Our guest speaker today, his name is Nick Abraham. He is with QC Capital. QC Capital is a privately held commercial real estate firm based out of Charlotte, North Carolina. They have a history of success in acquisitions, repositioning, and management of commercial real estate projects through major markets throughout the Southeast. And I know they're expanding their territories now in the South. I was just talking to Nick. He's got a new project here. It's in Houston, actually. So I'm pretty excited to learn a little bit more about that. Nick, how are you?
Good, Brian. Thank you for having us. We appreciate your time and putting us in front of all of your viewers of NuView and helping to provide some alternative investments.
Yes, thank you again for joining us. Originally, yes, it was supposed to be Chris joining us, but Nick is going to fill in for him. Will Chris be the one on the panel with us at the end, or will it be yourself?
I actually think they've swapped that out for maybe somebody else, but I'll be around to answer questions.
Okay,
absolutely.
perfect. So we're going to let you take over, share your slides, and we'll get started, and then I'll meet you at the end for the Q&A.
All right, sounds good.
Thanks.
Let me come here and share this. All right. And, all right. Can we see this okay? I think we can. All right. So QC Capital, we were founded in 2019 by Chris, who couldn't be here today. We come from BC, repositioning value add properties throughout the Southeast. We focus in major markets. This is the specific deal in Houston, but this is the type of property you'll see us looking at, anywhere between a 20 and roughly 90 million acquisition price in a major city. That's a Charlotte, North Carolina, a Raleigh, Atlanta, Georgia, a Tampa, Orlando, a Nashville, Tennessee, Houston, Dallas, Austin, all great territories. Like to see some demographic underwriting here in terms of income. So this property, like the last property we just acquired in March this year, is actually right across the street from a hospital. The property you see in front of you is Verdier at Herman Park, and we're really excited about this. It's a 224 unit deal, and we're assuming a 2.5% fixed rate on this, which is really stellar. You look at some of the seller financing deals right now, anywhere between 4.25% and 5.25% interest rate for the debt, and new debt somewhere north of that. So 2.5% is really the highlight of this deal. And they qualified by doing some renovations. The sellers that we're acquiring it from did some green initiatives, which qualified it for the HUD loan. No HUD tenants, Class A, and that term has 28 years left on it. So the next buyer can actually come in and assume the loan from us. So despite the market volatility with the Fed and what's going on, this specific asset is going to trade stable unless it makes sense to refinance at a lower rate, which between you and us, I don't know if we're going to see lower than 2.5% anytime soon. So moving forward here, this is our deck for the deal. Obviously, you can always find any of our managing partners information in any of our disclosures. There are risks with any real estate deals, just like any investment. We actually had this originally for $47 million acquisition price. It is now 44.2. We were able to get $2.8 million price reduction through retrades on this. Built in 2004 with a 2.66 acres, and average unit size is 975 square feet. Average rent right now is $13.92, and we're assuming roughly a 244 cost to lease on the non-renovated units. And I'll get a little bit more into that value add plan here in a couple more slides. And some operational efficiency, you'll see right here, occupancy is 88%. Market rate is roughly 91, 92, according to our CoStar data. And right now, the story we have from is just that they've transitioned to a new project within the last 9 months, and it's the slow leasing season right now. So hope to get that back up to market rate for an operational efficiency play. And some more reasons why we love it. The long-term fixed debt and the 2.5% at a 65% loan to value ratio. And we'll get here into our fund return structures. This is really the written out version. So I'm going to move here to the visual on page 10. And you'll see our Class A partnership is 9% preferred return, minimum investment of $100,000. So 9% on your $100,000 is $9,000 per year, and we make monthly distributions starting within 90 days of acquiring the asset. And we are set to close on this asset here in the next month or so, hoping to take advantage of the 100% bonus depreciation before the end of the year, which is coming out very nicely with a low land assessment. Going on to our Class B partnership, though, it's a 7% preferred return to the investor, with a 70-30 split, 70% to the investors, 30% to the GP team at sale until you reach a 13% IRR return. And from there, it would go a 50-50 split on that equity. And the minimum for that is $50,000. This class mimics our next class, which is Class C. It has the same preferred return at 7%. It has the same 13% hurdle in the waterfall. The difference being is that there's an 84-16 split after the 7% preferred return up until that 13% IRR, and then it goes 60-40 afterwards. And again, if you go now to page 11, you can put some scenarios in here at the minimum investment and what you could expect in terms of returns over the holding period, which I'm going to touch a little bit more on here. And again, we have a sensitivity analysis because I know a lot of you are concerned about cap rates pressing and expanding and everything going on in the market. But we do have a sensitivity analysis. We are buying this at roughly a 3.9 cap, and we're looking at a 4.8 projected exit cap. And again, there's some wiggle room on either side there to show you your IRR and your equity multiple. Again, a lot of this we already covered in terms of general, but I do want to take a moment to touch upon the submarket here. I don't know if you've ever been to Texas. It's an oil rig with a tumble field, and then there's a Lowe's, and it's very not master planned in my opinion relative to some of the other areas I've been in. So Texas is a very submarket place, and what we like about this deal is if you were to leave the hospital it's next to, walk across the street to the apartment that we're looking at, and then you walk a little bit further, you'd actually be in this luxury retail area. There's sidewalks on both sides of the street. There's trees planted. It's a very well-designed submarket within Texas. Another reason why I like it, again, you can see some of the things that are nearby. And then moving on here, let's look at the mix of the units. So most of them are actually going to be 62% are going to be a 1-bedroom, 35% are going to be a 2-bedroom, and 3% will be a bedroom. And, again, like we said, average rent here is roughly a little shy of 1,400. If you look somewhere in Charlotte, where I just moved out of, if I have people live all across the country I talk to, and we can always see the CoStar data for what one bedrooms are going towards. 1,400, shy of 1,400 is relatively low. And again, so we plan on bringing those up to snuff through renovations. Like you can see behind it, this is what all of the remaining units look like, besides 99 of them that have been upgraded already. We will continue this value add plan on those 99, hopefully achieving 33 of them completed per year over a 3-year period. In addition, we hope to cover some of the common areas, and like you can see here, the gym looks like it's from the 90s. Nurses, travel nurses living there, obviously are using this equipment. The pool furniture is a little outdated. The outside still has that 2004 yellow beige color scheme. The office area, if you can see one of those smaller pictures, a little bit outdated. So we're just going to bring all that up to snuff as well, and do some exterior paint to get the curb appeal, also helping to boost that occupancy level we saw earlier. And we're going to try to achieve this over a 3-year period, and look to do a sale in year 4. We'll keep scrolling here. You can see some of the unit mixes, layouts. These are the 99 remaining units to be renovated. They still have that yellow paint, the natural wood tones. And so that cost per unit is roughly $13,000 if you're wondering, $18,000 when you include all of the amenity and exterior upgrades as well. You can see a layout here of the property. Again, I'm going to touch on this for cost seg reasons, but there's not much land to it. So there was a very, very low land assessment, which helped our cost seg projections for that. So if that's something you are interested in, you are full-time in real estate, this might be a good opportunity for one of those tax write-offs. And moving forward here, expense ratio at 46%, occupancy 88. We touched upon our DSCR, which is our debt service coverage ratio. Usually Freddie Fannie look for 1.25. This is sitting at a 1.42. So some pretty good cash flows there. The equity raise on this is $27 million. That Class A we talked about earlier is capped at $3 million of funds, and BC will be a total of $24 million we're raising. And again, if you're interested in any of those, depending on your situation, you can mix and match between A and B or A and C. So if you want more cash flow or a little bit more equity, as long as you're reaching the minimum of those funds. And so we've touched on most of this already as well. 28 and a half years left on that term for the debt. And here, if you want to get a little bit more pretty with the numbers, you can see, gross potential rent and all of our breakdowns for the T. There's some healthy assumptions there in terms of the leasing office, and, our projections to get the right people in place to make sure it's effectively being managed on the ground. We use wood residential, touch a little bit upon that here on it as well toward the deck. They're our third-party property manager. And here you can see some of the rent comps and relative to where we see ourselves in the submarket. We're in that bottom half, which is where we like to be. We don't like to be top of the rent comps because it really doesn't show you're able to continue to push rents if you're the trend setter. So we like to see ourselves towards the middle or bottom of that list there. And here again, we have a sensitivity analysis based on occupancy, the gross income, our total expenses, and then that cap rate projected right there, roughly 14.2 to 15%. And that is for that Class B. It's a little bit higher again for that Class C because it's a higher minimum. And let's see, target demographic geographies. Houston obviously is a great market. And one of the things I want to touch upon is when most people set out to find deals. They find the deals that pencil, and then they try to justify the market. One of the things I really like that QC does that separates us is we're actually a market-driven theory firm. So, if you look at the Southeast and, operators over the last 5 years, population migration probably saved you if you had a bad deal. And now that the economy is shifting and we're seeing a slowdown in rent growth, we're seeing massive layoffs at, big retail stores and tech jobs and sales, it's really going to come down to who is your renting demographic and how susceptible are they to market downturn. If you're going towards maybe B and C class assets, you might have Amazon workers or boxers that are getting laid off in the thousands and also have hiring freezes, right? So that's an adjustment that, depending on what asset class you're going after, you're going to have to see no matter what. But again, it really comes down to that submarket and who your renter is. And again, we acquired another deal like this next to a hospital in San Antonio earlier this year. It's called the Palazzo, smaller 92 unit, $20 million acquisition, but average tenant makes $100,000 a year on average. And in addition, it's 100% collected by the 5th of the month. As we move forward in 2023 and its volatility, and I don't know if anyone expects it to be a great year, but that's something you need to look in terms of downside and how you're protecting, your capital and how you're diversifying and which assets really make the most sense. But that's one of the reasons we really like Houston and Texas in general. They employ a significant amount of the population in the United States to help drive that. And so being in those markets where you have strong job growth is really going to be the next predictor, I think. And again, you can see a lot of the employers around the area. Right here we have the Texas Medical Center. Again, this is what we're right near. This is the largest medical center in Texas. Rice University, as well as some big box retail, but lots of foot traffic here and lots of eyes on the property. So great for occupancy as well as we move forward. And again, you can see the office. We're going to try to uplift and what it looks like currently. Portfolio and case studies. So this is going to give you a snapshot of what we have done in the past. Again, we come from BC value add. We saw that writing on the wall with what was going to happen with our renters and these types of properties, and we started acquiring Class A. And so, relative execution on value add for Class A is significantly less than some of the older properties that have, not only the typical tenant turnover issues, but just what older properties find in general. And this is on the right here, this is a hangout area. There's a little coffee bar that the tenants use as well. So just trying to upgrade these amenity areas that they use, come down to work or whatever they may be using it for. And then here you can see QC Capital and the Durek family office. Ian is the family office, who runs that. Wonderful individual who already owns roughly 6,300 units in Houston already. Made for a really great partner for the Palazzo acquisition I mentioned back in March, and is partnering again with us on this deal. And again, knows the submarket very well, has been doing that for a long time now. And here you can see a few more of the properties. And then just to touch upon the QC Capital returns, Lionsgate was a deal we just sold roughly 2 months ago for 39% plus annual rate of return for the investors, which is phenomenal. Again, projected IRR, and that was between 12 and 16%, and it ended up at 36.19% IRR. Deal before that, 26%, deal before that, 22%, deal before that, 18 plus percent. So, we always, as you can see for the projection, put somewhere between that 12 to 16%. And obviously the market's a little bit different than pre-COVID, but you can get the gist that we like to conservatively underwrite and then try to over deliver for our investors at the end. And obviously if you're towards the end of the cycle with us, if you're just coming on, we do accept 1031s, and we can help you 1031 into the next deal as well. And Wood Partners also would Wood Development is one of the largest developers and property managers in across the Southeast United States. What I really love about them is that they come to every call with our asset manager here in the office, Sarah, with 4 or 5 people on the call to go everything from power washing to tree trimming to whatever is happening maybe with a tenant to overall strategy and how do we continue to make the property better, make the tenants here and continue to push rents, as we operate the property with them. I've been working with them for a number of properties now. And, as we continue to grow, are continuing to negotiate our property management fees. Again, one of the benefits of these larger deals, the economies of scale, and having partners like Ian with, a couple thousand units obviously helps too. So again, if you're unfamiliar with any of the terms and definitions I've used today, there's always a sheet in the back of our deck. And if you are looking for any educational materials, Chris Salerno, he has a podcast and a book. You can find that on Amazon or any of the listening streaming services. But if you are interested in working with any of our team, again, you can see us all here. There is Chris and Elijah, our managing partners. Elijah actually comes from Reef, which is a couple $1 billion fund. He managed a $200 million portfolio for them. Ian he built a waste management company and did a couple $100 million exit there. Chris was a top residential broker here in the Carolinas for residential before he got started in commercial. I myself come from a solar background, vice president, CFO. A lot of our team is very well distinguished and experienced, and we have a lot of that we can bring to the table. For example, renewable energies right now, and finding lower debt. There's a lot of avenues there, and obviously, great team here. You can see Ben Cohen does all of our acquisitions, handles all of our broker relationships. Zach does all of our social media. Sarah does all of our asset management. We found very early on, find what you're best at and stick in that lane. And that's always kind of been our strategy. But yeah, thank you for your time. And if you have any questions, happy to take them at the panel. And if you would like to get in contact with us or look at this deal, you can go ahead and find the link. I'm sure Maggie is going to throw that in there for you guys to look at, and we can always have a conversation from there. Thank you.
Nick. So if anybody has questions, go and get those submitted, and I'm going to read them off to Nick. So Nick, with the rise of mortgage rates, how is that affecting multifamily?
Yeah, so it's interesting. Typically, what you find is that NOI, which is your net operating income, after all your tenants pay, you paid all your expenses. That's typically what drives the purchase price of commercial real estate. And since Q1 this year, we were all using bridge debt, which basically means in 3 to 5 years we have to, pay the lump sum. And typically, what we do in that instance is we sell. But because interest rates started going up, the thresholds to actually make those types of debt pencil stopped working. And so, the volatility really took liquidity out of the market on the debt side, is what that means. The bank said your bank is your biggest partner. Equity is only 20% of the deal, 30% of the deal. The bank is going to bring the majority of the funds. And when the banks say, in Q1, we were actually, we had an LOI accepted. The bank said they were going to give us, roughly 70 million. And then the next day they come back and they came back 12 million less. And we're like, hey, wow. If we have to raise an additional $12 million, that's a lot of that dampens our returns. And now the deals don't pencil as much. So what we've seen is the liquidity dry up in the debt market has really driven the purchase price down. And the beauty of Verdere is that it has that fixed long-term debt that's assumable. So despite everything else going on in the market, our deal is just kind of chilling over here because anyone can come and assume that debt. And it has 28 years left. There is no balloon payment for the foreseeable future. And that's really been the highlight of the deal. Anyone looking for really stabilized returns, risk adjusted, the economies of scale, this is the place to park your money, and we're going to sell in year 4 projected. And, hopefully we'll be coming out of the market at that point. We'll have more liquidity come into the market. So maybe it would make more sense for someone to pay a higher purchase price, right? Because if we've acquired it in a deleveraged market and sell it in a leveraged market, that's just another value add play, in my opinion. More money means more proceeds at sale, which means higher returns for the investors. And so that's the game plan with that. And we like to have this deal under contract now, because as the rest of the market kind of still stumbles and still figures out, where the baseline is, we have this deal. And then once we're done raising on this deal, we'll be kind of more towards the bottom of that trend and not trying to catch the falling knife. So it sets us up for a really awesome second acquisition next year, I think, with creative debt. Again, what we're seeing, standard is seller financing is somewhere between maybe 4.25% and 5.25%. And then new debt that you might be trying to get from a bank is somewhere a little bit higher than that. So, you're never going to find I shouldn't say never, but you're not going to find a 2.5% again anytime soon. And because, again, these guys don't have to sell if they don't have to. So relative, if looking now versus 6 months ago versus 8 months ago versus a year ago, and they still have 10, 15, 20 years left on their term, maybe I'll just wait until the cycle breaks out again.
Yeah, interesting. Are you seeing more people investing using their IRAs because of the way the stock market's been performing these last 6 to 8 months?
Yeah, it's really tough. I've been active in the stock market since 2009, which was a great time to get started. Lots of volatility, similar to what we have in today's conditions. And the problem is that you might have to wait a couple years before the stock market really takes off again. BlackRock put out a really awesome report. It compares growth and inflation, and it does it over an economic cycle. And so the first cycle is high growth and low inflation. And that sounds like 2012 to 2019. And it compares all the different asset classes that you could have invested in: stocks, real estate, infrastructure, or bonds. Those four. Right. We know during high growth, low inflation, stock market had significantly higher returns on average. Then we go into high growth, high inflation. U.S. real estate takes off as the number one for average highest return. Yeah. Then we go into low growth, high inflation, which is essentially what we're in, the recession. It's still real estate, still a clear winner. So the next and last cycle is low growth, low inflation. So once Fed gets things curbed, we have, low inflation, we're still have low growth, but then we're gonna start growing again. Everything's relatively similar: stocks, real estate. So if we know right now real estate's the highest average, in the next cycle it's about even, real estate right now seems the time to invest. And then once you have low inflation and high growth starts to take off again, now the stocks is going to be the best place to park the money relative to other asset types. So, you kind of have to keep in line with the trends and what economic data suggests. It's a little bit, I'm econ background, finance background. So for me, I live this stuff. I breathe this stuff. I watch Bloomberg all the time. I'm watching 10-year treasuries. We live and breathe this. But, for the average person looking at their IRA right now or their 401k, it's someone dropped a grenade in it. And you look at the only asset class that hasn't really done that, and it's been multifamily real estate.
Right. Nope, I'm on the same page. I agree. And because of the mortgage rates being so high, those homeowners that were looking to potentially, purchase their first home, they're on the sidelines right now, and they're becoming renters even longer. So that's a good thing in multifamily if you're an investor, for sure. It's something for the economy for people that are looking to, buy their first home. It's going to just take a little bit longer. They're going to have to wait it out. And I think they're hoping the interest rates will drop. But I think there is going to be a correction happening in the next couple months.
Yeah. And it's interesting that you say that, we look at residential a little bit differently than we look at commercial. And everyone's like, oh, you look at, it's the fastest decline in real estate on the residential side right now relative to any other market correction. But then you look at interest rates and they're at 7.25%. As soon as they drop down to 6.5%, you saw mortgage demand pick right back up. So it's not that people left the market; they're just priced out. And eventually, when we hit that area, I call it an area of support. If you trade stocks, right, you find where it, you start to have these things trigger. You start to have these people come out that were, just not looking because they couldn't afford it. But now, as soon as affordability comes in, they're right back in the market again. So it's going to be interesting to see where that actual level of support is for the different asset classes. But yes, as affordability goes down, people are forced to rent because they can't own. And that obviously drives, apartment demand, and that supply demand dynamic isn't going away anytime soon, right? Development projections say, Freddie Fannie are saying 2035 before that's fixed. And then even if you look at that, we've always had about a 2 million units shortage, so we could keep demand where we wanted it in the growth, right? Because if you oversupply, just like 2008, all the developers have nothing to do anymore. So they're incentivized to keep that little bit of demand buffer there. And now as rates go up, it's obviously harder and harder to do carrying costs. You see DR Horton just did it's like a $50,000 price reduction. Well, people might do that, but it's only a change from rate. So again, interest rates are really driving liquidity at the moment. And cement is obviously fueling that even more.
No, I can relate to that. Okay. Well, Nick, thank you so much for taking some time to spend with our audience and, informing them on QC Capital, who you are, and, kind of the state of the market. Last question I have right here is, what is your exit strategy to protect your investors?
Yeah. So first thing is defendable assumptions. As we look at the deal, not only are we looking at the upside, we look at the downside. What are the downside potentials? And typically what we do is we raise capital up front to protect us, because the worst thing that can happen is you lose the asset, you get foreclosed on, and all your investors lose their money. That is the one thing you do not want to happen, right? And thankfully, what we're doing, the Class A is very stabilized. You don't typically see those types of things foreclosed on for a good reason. But the first thing I was going to say is we raise capital up front. So in case anything goes wrong during our 4-year hold period, we have capital to basically protect from things like that, that force us to sell if anything were to happen, right? Don't be put in a position to sell. And as long as you're on the first rule of real estate, which is location, you're going to end up with a profit at the end of the day, in my opinion. Regardless of what the market does in the short term, if you look at any investor in 2008, they would have said, I wish I bought. They're going to say the same thing in 2020. I wish I bought if they look back. And because it's long-term debt, we're never going to be put in a position to be forced to sell before we're ready. And again, that's kind of the backside protection for the investors in this case. Hey, if the market's still down and we haven't been able to push rents, in year 3 that we thought, we're going to do it in year 4 and then we're going to sell, or vice versa. It might be in year 4, maybe we have to wait until year 5 to actually sell. At the end of the day, it's all projection. Nobody has a crystal ball, but the closer you get to that endpoint, the clearer the crystal ball kind of gets. But again, as long as you're in a great location and you're not going to be put in a position to sell and take a loss, that's really how you're protecting your investors.
Yeah. Awesome. All right, Nick, once again, like I said, thanks for joining us. If anybody wants to catch this recording, follow us on social media. You can register for our upcoming classes. We've got some more in the series, and then our panel interview at the end. Everything's posted on social media. We do have an event coming up. If you're local, you want to join us for Christmas, we have a huge Christmas event for NuView clients, and it is free. It'll be at the Orlando Science Center. You can catch it on our website if you want more details. Thanks, everyone, for joining us again. We'll catch you next Wednesday at 1 p.m.